Hey guys, this is Rudy for Bester Investor. What I thought I would do today is give you a look inside one of my accounts to show you the kind of things I usually look at, even at a high level, when I try to analyze a particular stock. So there are a few things I pay attention to. So I'm sharing my screen. I'm actually logged into one of my accounts right now. And the first thing I look at is the sector performance versus the S&P 500. So I can see this is as of today. It is September the 23rd, the morning of, so it's Wednesday morning. And I can see the majority of sectors are lower, along with the S&P 500, which is down a little bit this morning. Specifically, I'm going to look at energy because, as you know by now, I am Mr. Oxy. So we're going to take a look at energy specifically. And energy, unfortunately for us who are long in energy, is leading the decline today, while some of the other things that we might be invested in, like industrials and financials, are actually positive today. So what I want to do, though, is I want to show you sort of within my TD Ameritrade account some of the things that I typically look at when I look at a particular stock. Let me just move myself a little bit out of the way here so that you can see what's going on. So we can see OXY right now. This is its snapshot. It's trading down 1% today. It's 14 cents. It's kind of trying to cling to $11 per share. It's not succeeding. Anyway, it's trading in a range of around $10.84 to $11.27. The volume is 32 million shares. You can see right at the top of the screen here, it says the volume is light. There's only 5.3 million shares being traded today. And the average volume over 10 days is 32 million. So you can see there's a huge difference there between the two. Of course, we know Oxy is trading at the low end of its 52-week range still. Very, very volatile, over 100%. The market cap, $10 billion, not at all reflective of what the company valuation should be, but that's where the market values Occidental today. And that's basically an accumulation of bad news, and then some more bad news. So what I specifically want to show you, though, is the valuation tab on here. So right at the top here, you can see where it says summary. So just above where my mouse cursor is right now, it says summary and then news and charts. And I'm going to go to valuation because that's the tab that I want to look at on an ongoing basis. So what we have here is the valuation analysis of Oxy, comparing it to its peers. So the peers, or the industry average, is the little black vertical line, and Oxy is the little gray block. So there are a couple of tabs at the top here. I'm on the valuation tab, and I'm going to look at them all very briefly. There's only 6 of them, so I'm going to go relatively quickly. Valuation analysis, because the earnings of Oxy are not available, the price to sales and price to book ratios are the most appropriate valuation measures. Therefore, Oxy seems fairly valued with a price to sales ratio of 0.87, which is in line with oil and gas, median of 0.93, and supported by a price to book, which is 0.75, which is in line with the industry median of 0.71. So those are the first couple of things that I look at. Price to sales trailing 12 months is a measure that values companies that are not profitable, that have no earnings. In other words, if you have negative earnings, that's what we're looking at. Price to book, MRQ, is the most recent quarter. The current stock price divided by the company's latest interim book value. So that's what we looked at there. So when we look at profitability on the next tab. So at a quick glance, you can see that Oxy is sort of in line with the industry if we look at the tables in the middle of the screen right now. So when you look at Oxy versus the industry, Oxy has a much higher gross profit margin than the industry. This is on a trading 12 months basis. It has an operating profit margin that is below the industry average and a net profit margin that is below the industry average on a trailing 12 months basis, but pretty much in line. So again, we look over here at the profitability analysis. Although losing money on an operating basis, Oxy has typically profitability characteristics of a company in the oil, gas, and consumable fuels. It does a better job than the median converting revenues to profits on a gross margin basis, but its operating and net margins are only on par with the industry norms. That'll change as we go along because obviously the executives have been working hard to try and cut costs and expenses. Dividend. OXY pays a dividend of 4 cents per year, which that's per share per year. At its current stock price, it's yielding 0.36%. This is way below the major oil and gas players like Exxon and Chevron, for example. However, most companies in the oil and gas and consumable fields don't even pay a dividend, so you can kind of get your own conclusion from this particular screen here. And of course, we know that OXY's executives are planning to increase dividends as they go along. Growth rates. So currently, the earnings trend at OXY has been weak over the last 12 months. The company has lost $12.58 per share compared to the previous period's profitable results. However, this performance was to be expected as the typical company in oil, gas, and consumable fuels also posted weaker results. So once again, you can see that OXY is kind of sort of in line with the rest of the industry, except on revenue growth for the trailing 12 months. So let's quickly take a look at what this means. The rate of increase or decrease in annual revenues over a specific time period, which is the trailing 12 months. This is quite a difference here between OXY and the industry, where OXY is positive on revenue growth, 18%, the industry negative at about 15%. Second last one, effectiveness. OXY is doing a poor job in comparison to its peers with a return on assets, revenue per employee, return on equity, and then I'll give you the numbers there. In particular, the company is below average at managing the owner's equity, while only average at generating revenues from employees and managing resources compared to other companies in the oil, gas, and consumable fuels industry. So on all of these 4 parameters on this bar chart here, return on equity, return on assets, return on investments, revenue per employee, OXY is lagging. So it is not scoring very well on effectiveness. And then lastly, we're going to look at financial strength. And we see OXY's debt to total capital ratio is 62%. It's in line with the oil and gas fuel industry norm, despite its increase over the past year. The company could face trouble servicing its debt. Of course, we know that already. The quick ratio shows that neither the operating profits nor current assets alone are enough to satisfy interest obligations. So that's one of the reasons why they have been disposing of some of their assets. If we look at the total debt to capital, we can see OXY is leading the industry. And on the others, though, so the change in debt, it's pretty much in line with the industry. The quick ratio is poor. We want a quick ratio of 1 or greater than 1. So let's quickly look what the quick ratio is for the people who don't know. It's the current assets minus the inventories divided by the current liabilities. A quick ratio measures the company's ability to meet its short-term obligations with its most liquid assets. The higher the quick ratio, the better the company's short-term financial strength. We want to see the quick ratio at 1. So for the most recent quarter, it is at 0.7. It'll be interesting to see what Q3 will bring and show us there. If we look at the interest coverage for the most recent quarter, it's the ratio of earnings before interest and taxes for the trailing 12-month periods divided by the trailing 12-month interest expense. So these are some of the quick snapshots that I look at as a general rule. So I always go to my valuation tab where I can see the valuation, the profitability, the dividend, the growth rates, effectiveness, and the financial strength on this line over here. Just above it are the fundamentals. You will know by now, if you've been watching my videos, that I always look at the fundamentals to see specifically the balance sheet and see what the company looks like compared to how the market values it. So right now, obviously, I am long OXY. I am comfortable with the fact that it's undervalued, and not comfortable with the fact that it had such a huge write-down in Q2, but I think Q3 is looking pretty good. It's very optimistic with WTI having been pegged at around $40 for most of Q3. The asset sales that have been announced, the management cost cutting on operational expenses and so on. So it is changing as we speak. But this is my sort of snapshot view that I usually look at, and I thought I'd share it with you in case you're interested in seeing that. So thanks for watching. This is Rudy for Best Investor signing off. Please subscribe if you like my videos, and I'll be back with more soon. Stay safe, take care, and talk to you soon. Bye-bye.